Interest rates move everything: stocks, bonds, real estate, crypto. When rates change, markets react instantly. But most people don't really understand why. At the simplest level, an interest rate is the cost of money. It is what you pay to borrow and what you earn to lend. When rates go up, money becomes more expensive. When money becomes more expensive, everything in the system starts to slow down. Borrowing drops. Spending pulls back. Growth begins to weaken. When rates fall, the opposite happens. Money becomes cheaper. Borrowing increases. Spending picks up. Growth starts to accelerate. But interest rates don't just affect the economy. They affect how assets are valued. Because every investment is a claim on future cash flows. And interest rates determine how much those are worth today. When rates rise, future cash flows are discounted more heavily. That means valuations fall. This is why stocks, especially growth stocks, tend to struggle when rates go higher. When rates fall, future cash flows are worth more today. Valuations expand. Markets often rally because money becomes easier and more abundant. Interest rates also shape behavior. Cheap money encourages risk-taking. Expensive money forces caution. This shift in behavior flows through the entire system. But here's the part most people miss. Markets don't wait for rate changes. They move based on expectations. What matters is where rates are going next. If markets expect higher rates, they begin adjusting immediately. Assets reprice. Risk gets reduced. Positioning shifts before the Fed acts. If markets expect lower rates, they start pricing in easier conditions. Assets rise. Risk returns. Liquidity begins to flow again. This is why interest rates sit at the center of everything. They connect Fed policy to economic activity and to market pricing at the same time. But there is one deeper layer behind all of this. Interest rates don't move randomly. They are driven by something even more fundamental. That is what we break down next. Because if you really want to understand markets, you need to understand liquidity. And once you see that, everything starts to connect.